Hey everybody, welcome to the Ankerstar Wealth Morning Update. No, I'm not driving down the road. I'm safely parked right now, although I'm in my car. We are up in Dallas for you guessed it, volleyball. Our youngest has an elite camp that she got an invite to, so we're up here and looking forward to watching her in the next couple hours perform with some of the best in the country. And then we're up here for the weekend for a qualifier, and so we'll be coming to you from somewhere up in Dallas tomorrow. But today, hey, there's green in the market. Anybody notice? Okay, if you haven't looked, you can look again. Right? Okay, look again for a little while anyway. But yeah, it's a nice green day after a big down day. We're going to talk a little bit in this show. I'm going to start us off by talking about the boring stuff, Fed interest rates and how is that going to affect the market. And guess what? CDs still pay 5.5%. Shout out to CDs, right? Because that kind of went away. Now it's back. I'll start us off talking about that. Mike will have a much more informative and entertaining topic when he talks about the concept of recency bias and how we as humans get caught up in that all the time. He's going to talk about where the S&P is in the last, not just the last week, right? Because that doesn't look pretty. I'm going to rewind it back to the beginning of the year and maybe a little bit past that, and then he'll conclude with kind of how we as humans need to think of things and how, and to get your mind around it to be able to kind of put everything in perspective. So that's what we've got for you today. It's a financial education presentation, so you have to do your own due diligence for acting upon anything you hear in this presentation. More information is available at ankerstarwealth.com, and the opinions expressed in this are mine and Mike's alone. Let's start with interest rates. Yes. Window, there we go. Here it is. This is from Tuesday, so a couple days ago, but the theme has been the same out of Chairman Powell and his team, is that, inflation isn't going away as fast as they thought. So therefore, it's going to, here's the headline, likely delay rate cuts. You can get in here. There are people out there. Stephanie Link is a known name in the investing world. She said yesterday that she has now changed her forecast to match Steve Ankerstar's forecast. Okay, she didn't say that on CNBC, but she did match our forecast of we don't think there's going to be rate cuts this year for myriad reasons. But one of them is, of course, inflation is always stickier than people give it credit for. It's like we forget. Maybe it's recency bias. I don't know. But yeah, it's not going away. So therefore, we're keeping those rates higher. You think blah, blah, blah. I can't afford a house. I roll all that stuff. Well, let's try to come up with a good angle for these rates higher. And here's what you're looking at. This is literally where Mike and I spend all day at the Schwab Advisor Center looking at your accounts. No accounts are in here except for this is just my account that we're looking at right now. But all you can see is when I go to buy a CD for folks, this is what I can get you today. Lock it in 5.5% from JP Morgan Chase, a name you've heard of, and out to 15 months. So if you kind of think of the history of interest rates and what Mike was saying during the IAB at the beginning of the year, which has already been 3 months, right, is that, hey, we want to move out in duration, right? We want to try to lock in these rates before they go away. Well, since they aren't going away, we're not doing that yet. So if you're like, hey, these guys aren't doing what they said they were going to do, you're right. If you notice, thank you for noticing. But yeah, we're kind of holding on to the CDs while they're up at that 5.5%. So they started the year at 5.5. They went down to 5.3 was kind of the best we could do, back up to 5.5. So my point is, if you got money in the bank, now's the time to hop in and get yourself a nice, sweet 5.5 CD. This will not last forever, but you can lock it in for 15 months at least, which is a great thing. And why do this before your bank instead of your bank? Well, we can buy and sell them. You don't have to hold to maturity, even though you want to. But, we have a lot more options available to us, and it's better than the CD that you're going to get for your bank unless you're on a teaser rate, because we don't tease people. We just bring them the best we can find them for the full term. So that's what I've got on where interest rates are. I'm going to transition to Mike now, who's going to talk about recency bias and the S&P 500.
Yes. So, Steve, I'll start off by saying on recency bias, yesterday I worked out and I made dinner and it was excellent. Therefore, I am in shape and an excellent cook, right?
Yes.
Because I just did it for a day. And so recency bias is something that affects all of us, and it's very hard to get caught up. And I'm very positive or I'm very negative. I hit the gym or I didn't, or whatever. So I just want to give you a quick example that I think people will relate to. When 4 people tell me their name, but I can only remember the last one. That is an example of recency bias. So that may have affected you. So recency bias. Can you remember back on March 28th, only 3 weeks ago, when the market hit all-time highs and everything was just golden, and there were no down days, and the sun was shining, and it was just great? That was only 3 weeks ago. So I want to look at the S&P 500 lately. So let's start off with just looking at it in the last 5 days, or actually 1 month. We'll look at the 1 month. And if I show you the 1 month graph, even though it's up a little bit today, it's like, oh, that looks awful. That's since March 28th. You know, you can see March 28th into that peak, and it went down, and it feels rough. That's recency bias. But if we look at the year to date, it's up over 5%. And if I told you at the beginning of the year we'd be in the middle of April, up 5%, and the Fed would be pushing interest rates back to 2025, you'd say, I'm pretty happy with that.
Yeah.
I at least I would be. I would be like, wow, the Fed pushed interest rates back. You know, the market probably is going to sell off, which it has a little bit. But overall, we're doing very well. So we're up 5%. And we just use the S&P 500 as an overall aggregate for stocks. Obviously, our models cross anywhere from aggressive to capital preservation, but the S&P 500 is a good gauge for that. So how do we avoid recency bias? It always helps to look at the long term and not, focused on the day or the hour or whatever. So if we go to 5 years, look at a 5-year chart. Yes, there's a dip in COVID time. There was a dip last year. You can see dips all along the way, but overall things go up. But that's only 5 years. Let's look a little bit further back to 1970. We call this the Mike and Steve's birth year, or almost a little bit earlier. But if you would have took $10,000 in celebration of myself and Steve being born in the previous year, and you'd have taken that 10,000 and said, I'm putting it in the S&P 500 and I'm going to ride it out. These are all kinds of things that have happened since then, good things, bad things. You would have $2.6 million. Wow. Mom, Dad, why didn't you just put 10,000 in for me back when I was born? I don't know. 2.6 million. That'd be pretty nice. But this includes all kinds of things from, the first mobile phone being sold, in 1984, Hurricane Katrina, the 9/11 attacks. You can see a big dip in 2008. Lehman Brothers filed for bankruptcy, kind of the beginning of that bear market there. But overall, the long term up. So when someone says, is the market going to go up? Well, the last 50 plus years it has generally, but day to day, we do not know, even month to month. So I'm going to show you a little bit more. I've showed this graph before. This always gives me confidence. This was at the end of the first quarter. The bottom, the kind of orange colored are what the market dropped off of the high that year. Coming into this year or coming into this quarter, it only dropped 2%. Every year, it drops more than 2%, at least at one point. So we're in that point right now. We're in a point. Do we know when it's going to stop? No, we do not. But overall, you see there's a lot more positive bars than the negative. It ends up, the blue bar is where the market ended that year. Here's another one. I've got some questions lately. Gold. Is it time to buy gold? Is it time? And I thought I would show this chart. Shows last 17 years. Let's look at the trend. Recency bias. Yeah, in the last week or 2 weeks, maybe like, oh my gosh, it's a great time to buy gold. But if you look at the last 17 years, stocks about 10%. Gold surprised me, 6.9%. And there was times where gold actually outperformed stocks, in 2008, 2009, right in there. But overall, stocks for the long run. Stocks won. Things like the 10-year treasury. I don't think we get a lot of like, oh, put me in the 10-year treasury. But, there are times that we want to be in when the USFR or CDs, 5.5%, things like that. Home prices. There's another one. Real estate, 4%, and you can see a couple other ones. And then the last one I wanted to show is just kind of like long term. Here's what you see in the stock market. So those up ones are bull markets. You'll see the runs of bull markets, and then you see those pullbacks into small bear markets. And you'll see the, small dips, usually short term, but it can be harsh to go through that. And so volatility is how we make money. We need the volatility. If everything was just a straight up arrow, guess what? That'd be an easy decision. We're all in all the time, and the market would just be stable. But since we get this volatility, it's a good time for us to make evaluations on when to buy, when to sell, how in a volatile market, when things go down, how do we get the best boomerang effect? How do we get the ramp back up, the snapback, as Steve's called it? So these are examples. How to overcome recency bias is to look at the long term. 20 years, 50 years, even year to date will give you a little bit of a longer term than a day or a week. So that's how I do it. When it comes to health, you can look on the scale. What's your long-term weight? Not did you lose 2 pounds yesterday? So anyways, that's what I've got. That's how you overcome recency bias. And, when things go down, it's okay not to open that envelope. It's okay not to go look at the stock market. And it's certainly recommended. Don't go watch the financial news, because they will really make you feel that recency bias. That's all I've got. And we'll talk to y'all later.
That is great information, Mike. And I like to, say in airplanes, there's a reason why you're not looking at the airplane crash network on the back of the seat in front of you while you're in the airplane, right? It's like, you can lose sight of things. But I think that's great information. Investing, everybody, is just like life. I mean, most of the time it's great. Things are going your way. Every now and then you take these heavy, punches to the face. You're laying on the canvas. All you can do is get back up and get back at it the next day, right? Same thing with investing. You know what? Things have been hit lately, but they're up today. We'll see more of that. Stay strapped in. So good information, good things to think about. With that, we'll leave you for today, and we'll be back with you tomorrow. You guys have a good one. Bye.